Welcome back to another episode of Financial Revolution Radio. I'm your host, Jaden Sterling. I've got a great show for you today. So much to talk about in the markets. If you are an investor who is wondering, here you are, July 20th, 2020, the markets globally in developed countries are at an all-time high. And you might be sitting there with money invested in the markets, scratching your head going, what the heck is going on? The economy, the real economy has absolutely tanked, right? We're seeing massive unemployment in North America. In the United States, 40 million people are currently unemployed. And the stimulus checks are running out the end of July. So we've had a bit of a prop up in the economy with consumer spending increasing because people, frankly, were making a slightly bit more money unemployed than they were being employed. So when there's a very common mentality that a lot of that stimulus money was free. A lot of people felt that way. And when people feel like they get free money, they spend it. I mean, that's the reality of the situation. So there was a lot of money flowing into the economy. I'm going to show you some interesting articles on the scenes for today, July 20th, 2020. And we're going to analyze these articles. We're going to talk about, what do you do right now as an investor? Do you stay invested? Do you keep your money under the mattress? If your money's in the mattress, do you pull some of that out and invest in the markets? I mean, it's a very confusing time. My hope is that I can break it down for you in helping you to become a financial revolutionist in your own life. As a financial revolutionist, you are someone who is wanting financial freedom, someone who does things differently than the herd. You're not part of the herd mentality. You're someone who is seeking solutions far greater than what most lamestream media is talking about. You're interested in growing your money. You're interested in leverage. You're interested in actually making a difference in your finances to last beyond your lifetime and into the lifetime of your heirs. So you're in the right place. Thanks for joining us. Got a great show for you today. Let's dive into the headlines and see, really what's going on in the markets and how you can best navigate this time. All right, so we're looking at the Europe agrees. They actually near agreement on stimulus fund with 390 billion in grants. I mean, this is just a massive amount right out from Zero Hedge, by the way. A massive amount of money that will be flowing into businesses and continuing to prop up this economy. Very important. As we know, the economic stimulus has been the thing that has allowed this market to not fail like it did in February and early March. We saw from February 19th to March 20th, approximately a 36% decline. But the fascinating thing was right around that time, there was also a tremendous amount of stock buybacks, meaning companies went out into the marketplace and purchased their stock in the open markets. And that helped boost the markets because there was support for the market. There wasn't a decline. So I wasn't very surprised to see that. Back in 2008, the Federal Reserve posted a mandate for corporations to put money into a fund that if there was another market decline, that money would flow back into stocks. And it did that perfectly. It ended up propping up the market. These companies bought back their shares at a super amazingly low price. Some of them got their stock 50 to 80% on sale. And they were able to buy back more shares, which means there's less shares that trade in the marketplace, which means that it's easier for stock price to go up. Doesn't mean that it won't take as much buyers as it did previously because there's less shares in float. Sort of a supply and demand situation going on there. Let's talk about Europe, though. The European Summit, which started on last Friday, continued into Monday today, where top politicians were meant to agree on the composition of Europe's recovery fund. Originally proposed was 500 billion in grants and 250 billion in loans. It was painfully, excruciatingly long, even by European standards, but it appears to have finally concluded. And following some rather heated and angry comments, mostly aimed at the Dutch Prime Minister Mark Rutte, hope I'm not saying that. I think I'm saying that correctly, who has emerged as Europe's new paymaster now that Angela Merkel, has succumbed to MMT. We finally have a deal. So what's the deal? Well, they previewed it yesterday. Instead of the 500 billion in grants demanded by Italy and all other deadbeat European states, and instead of the 350 billion that the frugal four were willing to release, Europe has agreed on 390 billion euros in total grants. Here's the headlines from Reuters. Latest proposal for EU leaders on recovery fund, repayment of the total 750 billion euro borrowing by EU commissions until December 31st, 2058. You heard that correctly, 2058. This is a very, very long-term stimulus plan that is being proposed. I mean, these folks aren't messing around. They recognize that they need to prop up the economy for a very long time. The effects of the decline in the markets and of this CV situation is literally financially devastating on the economies, but not the markets. That's what's fascinating. Like I mentioned earlier, there's a tremendous split between the financial markets, the economy, and reality, or the realistic situation going on in people's lives. So I'm going to show you another chart in a moment, what that diversion has created and what that means for you as an investor going forward. But for now, let's finish the headlines here. Latest proposal for EU leaders on recovery fund, 70% of all grants to be committed in 2021, 2022, remaining 30% in 2023. So again, a very long-term strategy here. A third deployed in 2021, next year, an additional third of that in 2022, so the following year, and then all the way into 2023. So what this tells us is this CV19 thing is not going away. This is going to be a situation that continues to plague our economies globally and the markets. And the only way we're going to get through this without everyone becoming financially bankrupt is to support from the local governments and global governance. So this really does speak to a global governance situation that's being created. This is far beyond, since it's now become a global issue, the CV19. Every country on every continent in the world on Earth currently is affected by this situation. So therefore, it's going to take a global response. That global response is going to turn into global governance, where there will be one government that will govern the entire world with the same laws, same uniformity in economies, in stock markets, in businesses. All of this is being created right now and is an outcry from this situation that we find ourselves in with this hysteria over this pandemic, this CV19. So your retirement is going to be affected by this. Your ability to retire will be affected by this. I mean, this is something that we need to really plan for as a revolutionist, a financial revolutionist. We have to start standing up and speaking out. If the mask wearing continues, if the governance continues in such a way that literally strips us of our rights, then we're going to find ourselves in a situation that is much more problematic than what is the stock market doing today. We've had a long, good run here in the markets. We've had, as an investor, I started investing in 1991, and the 90s were, a nice steady upward trend. There was high inflation, there were high interest rates, but there was a steady increase in the banking sector. It was in the 1990s that the banks took a strong foothold in lending and lent a lot of money in credit cards, the issuance of credit cards, the issuance of mortgages. A lot of debt was raised during that time. And of course, we live in a debt-based society. The US dollar is a debt note. It says it right on the back of that dollar. So debt is issued and additional debt is raised as they continue to print more and more money. So we find ourselves in a fascinating time. I mean, you probably are thinking, wow, what an incredible time to be alive, right? I think that every single day, to bear witness to this time in history, like no other time that has ever been experienced before, as we go through this. And the key is to navigate it in a way that is going to allow you to maintain some level of financial freedom. The only way to do that is you got to get ahead of this thing and not behind it. So how do you do that? Well, staying ahead of this market means investing in the sectors that are complicit in this global governance. You know, you got to be looking at companies that are aligned with AI, artificial intelligence. You know, AI is running the markets. It's super easy and clear to see the changing, the price movements in these markets. It just is beyond comprehension some days, you know, as you look at the fluctuations in prices. One stock in particular, Tesla. If you look at that stock, it's sitting at a level of $1,500 a share US, up from, you know, just recently when the market declined in February, that stock hit $300. It has risen 5 times, fivefold. And you have to ask yourself, why would that be? A car maker? Is it that sector, the idea of electric cars, did that sector just hit the right timing right now in order to run up like it has? Or are they part of a larger scheme and plan? If you recall, if you've been reading the headlines, that they issued or they launched 21,000 satellites into our atmosphere. And those satellites are to actually become the watchful eye, right? They're going to help the global governance keep a watchful eye on us so that they can track us, monitor us, follow us all the time. So isn't it interesting that the company that did that is now at a $1,500 a share, up from $300 a share? Folks, this isn't a normal market by any stretch of the imagination. This simply doesn't happen in a normal market where there's normal buyers and sellers. It is clear that the AI, artificial intelligence, has completely taken over the markets. And the good news is there's still money to be made in a market where AI is taking advantage of it. In fact, I like to submit that there's more money to be made faster in a market that's taken over by AI. All you have to do is simply look at what are the trends and where to invest. If you're an investor who needs some ideas or some inspiration or some logical sense, if you want to make logical sense of the markets, go right to our free software. It's the sterlingstockpicker.com. You get a 21-day, here it is, 21-day look at the software for free. After that, if you live in the US, it's only $30 a month. It's like you'll make that back 10 times on most likely on the first stock that you buy through the stock picker. It's called sterlingstockpicker.com, and that's where you find winning stocks. So yeah, you got to make sure that you are invested in the right stocks, right in the right sectors, the sectors that are complicit in this total pandemic, this governmental governance worldwide. There are, I mean, if we also want to get to what's really going on here, we're entering into an age of technocracy. Technocracy is that's why we're seeing so many corporate formerly corporate CEOs step up and lead the charge. Bill Gates is stepping up and talking about vaccines, and he has no medical experience or medical history, but he's still in charge of that, delivering the vaccines. And it's almost like he's become the spokesperson for it. We're also seeing many CEOs in these large corporations retiring. There's so much happening right now that we have to really lean into this and certainly not turn a blind eye. Do your research, do your homework. As someone who is a financial revolutionist who does things differently than most, you've got to be doing your homework right now and not relying on lamestream media to tell you what to buy and what not to buy, or to tell you to be fearful of the markets or not to be fearful. There's a way to play these markets that is you can certainly benefit from it on your own as you look at pulling your money out of institutions, financial institutions, which, by the way, are just designed to make money off of you, not for you. That is the truth. That is how the markets, these big firms are set up. Banks and brokerage firms, they are not at all set up to make you money. I know this. I worked in the industry during the 90s. I saw it firsthand. I couldn't believe. It was shocking to me how much focus was given on turnover in a client's portfolio, selling out their individual stocks and buying them packaged products that had high management fees. And there was absolutely no way that clients could become wealthy or make money on these investments. When I woke up to realizing the situation, I got out of the industry and continued to follow my internal guidance system. And I developed a system that allows people to find stocks super fast, align with their values, in order to create a winning portfolio. And I mean, if we can't rely on ourselves for financial freedom, there's no one else that we can rely on. You are your number one source to becoming financially free. It's not your broker. It's not your banker. It's not your insurance person. I don't care how nice these people are. It has nothing to do with nice either. It has everything to do with who has your best interest at heart, right? Who is most interested in you becoming financially free? Well, of course, your heirs are, right? They have a big vested interest in you becoming financially free. But most importantly, you right now, your partner, your spouse, or you're single, it doesn't matter. It's you. And investing in the markets is not at all complicated. In fact, in today's markets, it's super easy because you can go to an online investment firm. The one that we have an alignment with, an association with in Canada, is called Qtrade, qtrade.ca. They're the number one online investment firm. And as a subscriber of ours through the Stock Picker, you get $1 off on your each buy and each sell. So you get to save money right off the bat as a subscriber to the Sterling Stock Picker, and when you start investing with Qtrade. And you know what? You don't have to start with a lot of money. I remember I had a client in 1994 who told me about a woman who he knew who invested. She was a personal secretary, which, it was politically correct back then to call them, back in the 40s and 50s, a personal secretary. So she was a secretary in a law firm, and she invested $50 a week in companies, individual stocks. She had 4 stocks in her portfolio, and over a 40-year period, her portfolio was worth $1.4 million by investing $50 a week. How did she find these companies? It was actually kind of brilliant. She would look through magazines back in the 40s and 50s, and the ones that advertised in color, she thought to herself, well, they must be doing pretty well financially, because it was super expensive back then to advertise in color. So she was led to companies like Coca-Cola, Colgate, these big brand names, John Deere, the tractor company. She invested in these companies and just kept plowing money in it, reinvested the dividends back into her portfolio, didn't withdraw any of that money, and ended up a millionaire, $1.4 million portfolio, $50 a week. Just phenomenal, right? So if you're telling yourself, oh, you don't have enough money to invest, you actually do have enough money to invest. I'm sure that you can find $50 or $100 a week that you can set aside, invest in good quality companies that are growing at a decent rate in the right sectors in order to achieve financial freedom. It's not difficult. All it takes is discipline, all right? Showing up every single month, investing in the same companies. It's called dollar cost averaging. So let's talk about investing, though, in the markets. Here's an interesting article, again, from Zero Hedge. The odds are stacked against investors in a post-COVID economy. Now, I think this is an interesting choice of words here, in a post-COVID economy, because frankly, I don't see us ever being post-COVID. I think COVID is here to stay. I think you might agree with that too. It just seems like this is being set up in a way that COVID is going to be, continue to be around. There's going to be multiple waves, right? They're already planning now for the second wave of going through, and that's going to impact our economies and societies. We've already seen it in California, Texas, and Florida, where they're rolling back the openings, and they're saying, we opened up too soon. Now we're going to roll this back. And it's unfortunate because it's going to continue to impact our real economy. But this is what I find very interesting. Let's take a look at this article and dive in. If you're listening to this and not able to see this, please go to our YouTube page so you can see these charts and graphs, because they have real significance and meaning right now, and I think it's going to be important for you to take a look at. So here's a chart. The reversal in the NASDAQ 100 coincided with the second largest number of buying climaxes in those stocks. Only early 2018 had more. So take a look at this. Let me just click on it to expand it. And so you've got this chart. This is a 3-year chart showing all the times where the NASDAQ rose to an all-time high. And so if we can see 3 years, right, we started here at September 17th. September 2017. And then we're showing, let me get rid of my picture here. And it's showing all the way through current day, July 2020. Again, at an all-time high, huge run up in the NASDAQ. And that's made significant money for people. Remember, the NASDAQ is tech heavy. These are mostly technology companies that are invested on the NASDAQ. And that is, we can't ignore technology companies right now in the marketplace. They are the ones that I keep saying that are absolutely making this entire global technocracy possible. And you need to start investing in some money there. I just want to show you a couple more things that I find interesting. Where are we here? Right here, since 1947, earnings per share have grown at a 6.21 annual rate. Now, that is, I think, reasonable. I think that a 6.47 or 6.21 annual rate is a reasonable growth rate. It's a lot if you think about it. That means year over year, these stocks are growing at that rate consistently. While the economy, now let's link it to the economy again, while the economy expanded by 6.47% annually. So earnings per shares were almost tracking what the economy was expanding at. That's a super close relationship in growth rates, and is significant in terms of the role that the consumer spending has in the GDP equation. Now, this is where it gets interesting. As the economy expands and as earnings expand, when there's an expansion in the economy, that drives personal consumption. When, think about it in your own life. When you have a steady paycheck, and you're working and you're earning money, that's going to give you a high level of comfort to spend money normally, right? Like you normally would. And it says here, the consumption function. While stock prices can deviate from immediate activity, reversions to actual economic growth eventually occur, right? So even though stocks can, which is what we're seeing right now, we're seeing a deviation from economic activity in the stock market, right? Stock market's high, economics not so good. But such is because corporate earnings are a function of consumptive spending, corporate investments, imports, and exports. So essentially what they're saying is that stocks are continuing to go up. The earnings are actually coming out decent. Netflix just posted earnings last week. They exceeded in their new subscriber numbers, but they fell short in their net profit numbers, and that sent the stock tumbling just for one trading day, because don't you worry, it's right back up 2 days later, right? But what we're seeing when corporate earnings are a function of consumptive spending, that's consumer spending, that's you going out spending money. Corporate investments and corporations investing in their infrastructures and their businesses, imports and exports. Most importantly, out of all those, there are two things. You probably guessed it: consumer spending and exports. Right? Unsurprisingly, there is a precise correlation between PCE and GDP. GDP is gross domestic product. If consumption contracts due to high levels of unemployment, if consumption contracts, slows down due to high levels of unemployment, then economic growth declines. Well, of course, we're seeing that right now. It's very easy to see in this chart. Look, it's off the charts, isn't it? It's nearing the negative 4.0 range in gross domestic product. And folks, that's just going to get worse. I mean, that's just going to continue to go down. And what they've done here is, you can see the gray area. Again, if you're not seeing this chart, if you're just hearing my voice, please go check out our YouTube channel. It's Financial Freedom Radio. You can find us there. While you're there, please remember to subscribe and hit that like button, right? Hit that that notification button as well. And you're going to be able to see these charts that I'm referring to, because this is important. This highlighted area here back in between 07 and 09, that was called the Great Recession. It was actually technically a depression because there were more than 2 consecutive quarters in a row of economic decline. That's how we define a depression, and that certainly took place. It was more like a 3-year period. It was brutal. And any of you who were investing in the markets or had a business at that time, you noticed a lot of pressure on your business, a decline in business, a decline in your portfolio. So as this recession rolled through in 07 and 09, look at the decline and look at the lines right on top of one another. Gross domestic product monthly down, right down in the, what's that? Call it minus 3% territory, along with a decline in personal consumption expenditures, PCE. Same, right? Almost these lines are on top of one another. But look at the line currently. Let me move my picture out of here. We're seeing GDP monthly at 0, right? Gross domestic product at 0. But look at the personal consumption expenditures down. It's worse than that time period during the Great Recession. Do you see that right there? It's significantly worse. And what is going to happen is, that's what it says here. However, when it comes to investing, exports are a critical factor. Exports comprise roughly 40% of corporate profits. Here we go, my friends. This is why we're seeing the market somewhat able to maintain the levels that we are, because of these exports. These corporate profits, and also have a high correlation to consumption and related economic activity. So what they're saying is, as long as exports remain high like they currently are, we're going to continue to see a decent stock prices. That's simply what's going to happen. Since consumers in your current, no matter where you're listening to this in the world, if consumers locally aren't buying the products, then they're being exported. And that's what we're seeing here, because consumer consumption has dried up, and yet exports of goods and services are still quite high, right? Because these products have to go somewhere, right? They're not going to just put them in the rubbish. They're going to export them and still earn money. So again, it should be evident that corporate earnings and profits correlate highly with economic activity. Of course, that makes perfect sense. While business, investment, and government spending do have an input into the economy, consumption ultimately drives profits. So that's what we're going to see. I think we're going to see a diversion in corporate and balance sheets, because corporations are bringing a lot of stimulus from governments, local governments, federal governments. And then we're going to see a slowdown in revenue, though. So we're going to see strong balance sheets, cash flush companies. I mean, that's literally what's happening. These mega companies that trade have billions in cash right now because they were given grants or loans to keep their employees on staff. But, and this is a big but, but people aren't getting the paychecks that they want. They've cut back. Everyone who I know, so many people I know who were able to keep their job through this decline in the economy, their employer cut them back some 25%, enough so that they actually said, you know what, I'm not even going to continue to work here because I'm doing way too much work for little money. So people are being driven out of their jobs because of a reduction in pay. When there's a reduction in pay, there's less personal consumer expenditures happening, and thus it's going to dry up the economy. So where do we go from here? I think, and I've put a lot of thought into this, I think we go to, I think we have to get back to what we know about the markets. I'm a 30 plus year investor in the markets. What we know is the markets always climb a wall of worry. Whenever there's great worry about whether or not stocks are going to go down, the markets seem to stay up. And the second thing that we know to be true about investing, the trend is your friend. It is clear to see that this market continues to trend higher, and you have to be invested in it in order to win it, right? You got to be in it to win it. Money doesn't like scared money. You got to stay in it. So, I guess the question is, what the heck are you waiting for? If you have money on the sidelines, get it to work in this market. Don't be afraid. You don't have to bet the farm, but at this point, I think, and don't hold me to this. This is investment advice on a friendly nature. This is where I have to say, that you cannot sue me. This is for educational and entertainment purposes only. However, if you are an investor and someone who has money set aside, we're going to continue to see the markets go up in certain sectors. Now is the time to be acutely aware of where to invest your money. You can no longer throw money into this market and expect that a rising tide raises all ships. It doesn't. However, if you pick the right sectors, I've already talked about this technology sector, that's huge in driving this market forward and will continue to be very valid in a COVID economy. We will always be in a COVID economy. If it's not COVID, it's going to be something else that will be created in order to take away our liberties and freedoms. Unfortunately, that is the case. So here's your workaround. Stay invested in it. If you're looking for the right sectors to invest in, if you're looking for winning stocks, just go right to our Sterling stock picker. This thing is so good. It's so simple to use and understand and navigate. You can find winning stocks that are aligned with your risk tolerance level and your personal values. Like, we've built this thing, it's so solid, and we think that you're going to really get a lot from it. So go to sterlingstockpicker.com, grab your free 21-day trial offer. Won't cost you a thing. You get to take it for a test drive, see how it works, and see how easy it is to find winning stocks. We track everything. You even get your personal ticker tape here scrolling across your screen, so you can track your stocks on your watch list and in your portfolio from any device, anywhere, at any time. So my friends, that's my show for you today. Thanks so much for tuning in to the Financial Revolution Radio, where we assist revolutionists to have financial freedom, one investor at a time. Thanks for joining us. Look forward to seeing you on the next show.